Well, welcome to our High Rock Monthly video. I'm Scott Tomlinson, and with me is my partner, colleague, and the original founder of High Rock, Paul Tepsich. Well, it's midsummer, so we will try to keep this brief so you can get back to your summer activities, which we hope that you are safely enjoying within the next stages of economic reopening. But let's look at what happened through the month of July. So volatility remained relatively high as compared to what we saw at the beginning of the year, but certainly well off its peaks, and certainly well off the peaks that we saw in June. Performing financial markets, well, gold, and we'll talk about this in just a second, was certainly gold and silver, which we have some exposure to, was the big performer. Canadian preferred shares saw a significant uptick in value, and I'm going to get Paul to talk about that briefly. Certainly US equities led global equities. Canadian equities were lagging somewhat. Canadian bonds still positive, and even REITs were ever so slightly positive, but closer to being flat on the month. Paul, let's talk about our position in gold, silver, maybe.
Yeah, sure. We, as our existing clients know, we bought, certainly for older clients who've been with us since before April, sometime in mid-April, we bought a position in CEF Central Fund, which is run by Sprott, but it is 68% physical gold, 32% physical silver, held at the Royal Canadian Mint. So there are no futures or options or any derivatives of owning gold and silver. This is physical gold and silver that we can actually submit our shares in the fund and take physical delivery ourselves if we wanted. So our timing at the time we bought this, I thought we were a little bit late, maybe 6 months late and a couple years early, but the downdraft or the decrease in value in the US dollar has really prompted a lot of commodities to move higher, because all commodities are priced in the US dollar, being the reserve-based currency in the world. But there has been, as you can see, a very big move into gold and silver, especially silver. It's darn near doubled in the past 4 or 5 months. And I've said this before, I'm glad we own this fund. I did a fair bit of research to figure out what was the best way to get exposure to gold and silver, and silver is extremely volatile, and it's something we do want exposure to. So anyway, we're up probably around 26% on this since mid-April when we bought it. So I'm quite pleased with that. And as you noted, Scott, the yellow line, Canadian preferred shares, mid-month in July had a very sharp move upwards, and the reason for that, there's a technical blog I wrote last week. I would refer clients and listeners of the video to. You can go read it there and contact me if you want. But as I said, it is a bit technical. But the bottom line is that Canadian banks have to meet certain capital requirements, common equity requirements, and to do that they were issuing Canadian preferred shares because that was the cheapest way for them to issue what's called common equity to meet those hurdles. And they were issuing, the big 6 Canadian banks have been doing, over the last 5 years, have been issuing about $5 billion a year, and that's weighed very heavily on the preferred share market. But it was the cheapest form of funding in the common equity for them to do so. And lo and behold, RBC last month came up with a new security that qualified for what they call additional Tier 1 capital. And it doesn't involve issuing a preferred share per se. It's issuing more like a bond with a preferred share sitting on the sidelines in case they default on that bond. So they did about $1.5 billion around the globe, and it's an institutional bond, not a retail instrument like preferred shares typically are. So nonetheless, that relieved a ton of pressure or supply pressure in the preferred share market, and that's why these prefs jumped up sharply mid-month July. And I think they can continue showing. They've certainly settled down, as you can see by the performance in the back half of the month of July. But they were just cheap. You know, Scott, some of these were like one of our holdings, BCE preferred.K, was yielding darn close to 8% on an internal rate of return basis. The cash yields in these things are anywhere, 5.5 to 6.5 type percent, but the IRRs, or internal rate of return, were much higher, and the market was just ripe for some sort of movement or increase in value, and that was it. So the RBC figured it out.
Well, that's a very interesting story, and obviously we do own some preferred shares, so that's helped them. Paul, going forward, does this have any further significance in the preferred share market? Will we see less issuance from non-bank preferred share issuers as well?
That I'm not. That's a good question. I'm not sure. Well, you can see that the bank rate reset preferred shares increased the most, because that's where I think they'll all follow suit. National Bank and Commerce may have a harder time, certainly National Bank, because they may not be issuing investment grade paper. So there will still be supply for sure. In the non-bank preferred shares, there will be less. So for instance, BCE or the life insurance companies, they will likely continue to issue some prefs. Energy prefs and whatnot, they didn't increase as much. A lot of the increase was in the bank preferred share market. And then moving forward, clearly there'll be a lot less supply for sure, but the market may be a little bit more bifurcated between Canadian banks and all others.
Excellent. Okay, well, that's great review for that. Let's look at what's gone on year to date in our financial markets. There again, gold, silver, big outperformers, but Canadian bonds to date on price alone are still the best performing asset class in for this year. And then if you add on the coupon on a bond, so you get an extra couple of percent on top of that to give it the real return. So certainly the best performing asset classes are bonds, and followed by U.S. equities, which now are above break even on the year, and then global equity still slightly lower, Canadian equity failing to sort of keep up, and there's more of a longer term perspective on the preferred share and REIT markets as well. REITs obviously dragging down, and certainly I think that has a lot to do with the state of the rental economy right now, not necessarily in the residential, but mostly in the commercial REIT space, right, Paul?
Yeah, for sure, and that's part of the reason we've been somewhat bearish on retail for quite a while. It's part of the reason why we don't own any REITs and haven't owned them in multiple years.
Yeah, and then just as a highlight, our client portfolios are pretty much, I would say, everybody's now in positive territory on the year, which is great. Depending on your portfolio strategy and your risk, your allocation to risk and higher risk, there's quite a dispersion of returns, but nonetheless back to positive for pretty much everybody. And don't forget that these are returns after fees on an annualized basis. Let's talk a little bit about our portfolios. Our standard 60-40 still has a fairly good cash yield, and again, that's just the dividends coming in from and interest income from our holdings. Not a lot of changes, Paul, in the fixed income. Certainly not a lot of changes in the global equity model. We're still underweight global equities, but certainly a little more heavier in global equities as markets improve. So that just generally improves us, and we're not yet at a place where we feel the need to sell anything in a rebalancing way. So we're pretty much running with what we have in global equity, but we're certainly not interested at this juncture in making any purchases of anything that isn't value. Maybe you want to talk more about the tactical portfolio, Paul?
Yeah, maybe we can talk about a couple changes. Number one, we added to our Enbridge common equity position, common stock position, just last week. We had bought it pretty much at the low, but we didn't buy enough back in March. We bought Enbridge and TransCanada Pipeline, or TC Canada, whatever it's called now. So we added to that position, and the reasoning, I think, is just the infrastructure that both TRAP and Enbridge own and operate will continue for a long time in the future. They were starting, especially Enbridge, with a very small footprint in renewables. It's only about 5% of cash flow right now, so kind of de minimis. But the overall business, the bread and butter business, is performing extremely well. This company got out in March when we bought it around a 10% dividend yield. It's currently trading just under, when we bought it, just under 8% dividend yield. I think it's still very attractive in an environment where government bond yields continue to drop. This company has a history of increasing dividends, so dividend growth is important. So we did add to that. That was the one change in the tactical. The other one, which is rather topical this morning because they just issued their second quarter report last night, is Yellow Media, which is a pretty good investment for us because our clients in the tactical own both the common equity and the convertible bond. So the company had phenomenal performance. I think there was a lot of fear. The stock, let me start with the stock first of all, Scott. It is illiquid. There are about, some large institutional holders own about 80% of this outstanding stock. So it recently has traded off probably 20-odd% on very little volume. There could have been a seller of 30,000 shares, and it sold off from 10 to below 8. We did do a little bit of buying for a new client. I'm glad we did, because the report from last night and the conference call this morning at 8:30 was very positive, and the stock is up 15-20% this morning alone. So the reason why we like this company is its cash flow is decreasing, but at a much slower rate with this new CEO who's been in the seat for 3 years and just signed another 3-year contract. I really, really like this guy. I've had multiple conversations with he and the CFO. So some of the highlights from the call this morning were revenue declined less than they thought due to COVID. So most of their, well, you said, in fact, some of their clients decreased spending, but they didn't stop spending. They didn't pull contracts. They're typically on 1-year contracts. So these are all basically what are called SMEs, small, medium enterprise businesses. So they initiated a new NCIB, a normal course issuer bid. They can buy up to about $5 million worth of stock. They committed to buying back the bond we own, which is one of our biggest tactical positions. They're going to be buying that back in May 2021. So what is that, about 9 months, 10 months away, 9 months away? That bond has an 8% coupon. It's trading at par. It's not going to move up or down from there. Well, somebody could pay more for it, because 8% for a bond is going to be taken out in 9 months. And they can do so with cash. They've got 110 million cash as of yesterday sitting on their balance sheet. This bond is 107 million. So this company is now in what's called a net cash position. In May 2021, we will have our bond called from us at par, or $100. what is going to be left in the value of this company is the stock. That's why this stock is up 15, 20% this morning. So I'm glad we did a little bit of buying for some of our newer clients, and we will continue to hold this stock. My estimation on this stock is it's worth somewhere between $14 and $23 right now, and that's based on $14 based on an enterprise value multiple basis on the cash flow, and the $24 is based on a discounted cash flow analysis model. And the stock right now is trading at 9.5, up from under 8 the last week. So I still really I love this CEO. I like this company and I like this stock. Our bond is now, there's nothing to it. It's just, we're just going to ride it out and take the coupon or the carry until May 2021. But this stock will start appreciating now because, oh, the other thing, Scott, I forgot to mention, the other positive is they initiated a dividend, which they told us about at the end of the first quarter report, but they actually are paying it in early September. That dividend is 11 cents a quarter, 44 cents a year. It's around a 5.5% dividend yield paying stock now. So this, for this company, it's kind of unheard of. This guy has done a phenomenal job. So I'll leave it at that.
Well, that's excellent work, Paul, and it highlights, I think, to a large degree, why we do have the tactical model. Sometimes it takes a while to find an opportunity, or even we find an opportunity and it takes a while for that opportunity to come to fruition. So, it may lag in performance. We may see lags in performance from time to time, but when things do come to fruition, obviously there's a definite amount of outperformance, and we have to be patient and good work on being patient with this.
Thanks.
As we mentioned, it was a good month in July. The beginning of August has been a good month. We also are displaying a smaller portfolio that we've put together at the beginning of this year for some of our smaller and younger clients. That portfolio is really booming. We were in the beginning quite tactical about how we purchased it, and now that we have, we're letting it run, but it's running really nicely because it's got a fairly strong exposure to equities and a bit more technology. So it's done quite well in the year. But even our tactical portfolio is now our 60/40 tactical is now well above the beginning of the year, and our more conservative portfolios are doing well as well. So all told, by being more responsive to the risk in a portfolio, we limit the downside, and we're now able to capture the upside as markets improve. And I think that's a really important part of what we do here. And again, it's always about the long term, but we do want to keep short-term volatility down. And that's something that we're always working at, and trying to keep our return per unit of risk as high as possible. But that means that we try to keep our risk through that standard deviation as low as we can to achieve the maximum return that we can within those risk parameters. Well, we always say, and I wrote a blog about this, but we do hope for the best because we are long-term cautiously optimistic, but we always have to be prepared for the worst stuff to happen. And let's just look at what does keep us up at night. We're still obviously very concerned about the coronavirus and the COVID-19 cases confirmed and deaths. We think this is something that is sticking to consumers. People are reluctant to venture forth and engage in the economy to a large degree because, and I'll get to this in a second, but we've seen a significant downturn in GDP. We talked about this last month, but let's talk about the consumer. Consumer sentiment in the U.S. is 2/3 of annual growth, and you can see that consumer sentiment obviously has fallen. It jumped back up towards or into June, but through July it's starting to fall again, and a lot of that has to do with what's going on in the world of being employed. Unemployed people just don't have the interest in spending, discretionary spending. So consumer spending is likely to remain somewhat subdued until there's more confidence that people are going to have their jobs and job security going forward. And I think this is a big concern at the Federal Reserve, as they've been saying. They have and will monitor the economy and do what they can to make sure that that growth is not as impaired. But one of the things that we are continuing to watch, and new news today shows that jobless claims in the United States remain stubbornly high, and a lot of it has to do with coronavirus cases increasing in some of the United States and in parts of the United States. So obviously that kind of uncertainty is hanging over the U.S. economy. It's also hanging over the global economy. It's hanging over the Canadian economy, and there's still a huge gap in employment. So tomorrow we'll get further readings on what happened in July in employment. It is expected that employment actually stalled in Canada as well as in the United States. So unemployment rates stalling at current levels, and that's not good for economic growth going forward. Stocks, we think, remain expensive. We've covered this in the past. So again, they're not cheapening up. In fact, as they get stronger, and Paul, you may want to chime in on this, because there are other metrics that we use to look at stocks, but certainly as a function of earnings, stocks are quite expensive.
Yeah, I would just add that what we're seeing here in the valuation of stocks on a PE basis, it's really called multiple expansion. So there are many different ways of looking at stock value or company valuations, and one of them is obviously the PE, or the price to earnings. But effectively, if we broke down, the earnings have dropped due to the COVID and ensuing recession, yet stock prices have gone up. So the real boost has come from a pile of analysts and investors just going, I don't care. The economy is going to rebound substantially, and I'm willing to pay a lot more of a multiple for those stocks based on the earnings. So it's kind of a pie in the sky sort of view of valuation, just going, I move my multiple from whatever, 14 times to 25 times. I don't care. That's sort of what we're seeing right now, multiple expansion, and that can be dangerous, as we saw back in February and March.
We've talked about this before. Central banks have added significant amounts of liquidity to the system, and certainly it is one of the reasons that stocks are being driven. There's a lot of excess cash, and that cash needs to be put to work. And investors are choosing to buy stocks because they see more potential, I guess, to the upside. I think we're somewhat skeptical of that at this point. And Paul, maybe we should talk about this a little bit. What's driving the S&P 500 is really only 5 companies, right?
That is a fact, for sure, or largely, yeah. It's, as you can see here, I mean, chart compliments of David Rosenberg in one of his morning notes a week ago. It's something we probably have all heard about, but this really puts it in perspective and just tells you how much of these FANG stocks are responsible for the big move in the S&P 500. And it's, you know, he's turning it into the S&P 5 and the S&P 495 being in the blue line. They're barely up. You know, even year to date, I think they're still down substantially. I'm not sure what the 495 companies stocks are down year to date, Scott, but I think it's down, 10 to 15% still.
Yeah, I that's what he did say. Yeah.
Yeah. So, clearly that has been the trade for the last 4 months, is owning these tech companies, these FANG stocks.
Yeah, and historically we call this market breadth or market depth, but historically, when only a few stocks are driving the whole index, it is and has been a bit of a warning sign that this situation won't last. So we have to obviously be somewhat cautious about where stock prices are as a result. Let's talk a little bit about politics. We know that it's going to be impactful to a degree. There's still a lot of toss-ups according to the polls right now as to who could get the electoral college. Certainly, the Biden versus Trump polls are favoring Biden, and then if you want to follow the money, the betting odds are such that Biden's got a wide lead over Trump. So that's something that obviously is interesting. So we do monitor how this is going. Although all we know is that this adds certainly to the uncertainty. And Paul, as you mentioned last month, if the Democrats sweep, we can expect some significant tax increases going forward, especially on the wealthy.
Yeah, I think tax increases, although, they may have to be careful how they implement those, given how fragile the economy is right now, coming out of this, being in this recession and perhaps coming out in the back part of the year. The other major problem, if they do have a sweep, is that I feel like, given the comments some of the far left in the Democratic Party have made about share buybacks, if they eliminate those in entirety, that is going to be extremely problematic for the overall stock markets, because quite frankly, for the last 12 years since the Great Recession, the global financial crisis, say for the past 6 months, the only buyer of stocks has been corporations themselves buying back their stock. So that would be a real problem for the market. We could also mention too, over the past month, I did read an article last week about how company insiders, so those would be folks that are on the board of directors and the CEO, CFO, et cetera, have been huge sellers of their own company stocks in their personal accounts. Never really a great sign.
Yeah, always telling, that's for sure. Okay, well, what are the things that we're hoping for? Well, we know that things in Canada are significantly better than they have been in the United States with regards to COVID-19. Although there has been an increase recently in Canadian cases, and I think it has a lot to do with reopenings and the fact that, and the cases seem to be somewhat younger folks, so it would appear that as lockdowns have eased, younger folks are getting out a bit more, and I think that's sort of pushing the situation a little bit, but we can be quite happy that in Ontario, anyway, we're into the next stage, stage 3, and that is certainly positive from an economic perspective. We also know that there is lots of progress being made on vaccines, and the U.S. Head of Dr. Fauci has suggested that there could be enough vaccine doses by early 2021, but there's still a lot of time between now and then, and certainly from what I'm reading, there's still a very significant number of folks in Canada and North America who are reluctant to venture forth until they're more comfortable that this COVID-19 pandemic is heading in the right direction. Okay, finally, on an administrative note, we want to introduce latest High Rock associate, Diane Leckie, who is joining us as a senior client service representative, and she's going to be taking over all of the administrative duties from Bianca, and that's great. We're excited to have Diane on board, and over the next couple of weeks, you'll be hearing more from us, but certainly we'll be sending you her details that are here, but you can Bianca will be forwarding any administrative requirements that clients have onto Diane, and so I'm looking forward to all our clients being introduced to Diane as time moves forward. So welcome, Diane, and we're thrilled to have you on board. I've enjoyed lots of conversations with clients, and I haven't been initiating those. I've been receiving them from people who want to have a conversation, and they've been great conversations. I think for the most part, everybody's pretty happy with how things have gone. We limited the downside. We're capitalizing on what's going on now, and we're back into growth territory, and it's great. But I won't bother you as summer moves, but I'm happy to be bothered by you if your time is has room in it. So please don't hesitate to get in touch. Happy to be here and standing by for anybody who has any needs for conversation, or if you want to discuss your portfolio and strategy in more detail.
Yeah, likewise with me, Scott, and welcome to Diane, and to all our clients, stay safe and enjoy the balance of summer.
Yes, stay safe, stay healthy, and we look forward to engaging with you again at the beginning of September. And also a reminder that, and hopefully you've all received an invite to our Zoom meeting with David Rosenberg, which we'll be hosting instead of the live meeting. Unfortunately, we just think that is a safer way to go for the time being, but we didn't want to postpone that any further. So please, if you have not for some reason received your e-vite, perhaps it went to your junk mail. Sometimes that happens. But please, if you do want to be part of it, let me know. Otherwise, so I can make sure you're included. But we'll have more information on that as we approach the date. But it is September 16th, and it will be at 6 o'clock.
And Scott, just to add, we are hoping to still have an in-person party event with David Rosenberg as the guest speaker at some point in April 2021 at the Albany Club on King Street, east of Yonge, but that is subject, of course, to us being able to gather and do so. But we would be excited to host a bit of a party.
Indeed. All right. So again, we'll sign off now, but we look forward to resuming next beginning of September. Till then, all the best.